Gemma, as a qualified financial advisor, how have you noticed the pandemic shaped what investors look for and their investment preferences?
It's been an incredible couple of years, to be frank. Aside from obviously the pandemic and its impact on our lived experience, what it's done for investing and trading has been absolutely fascinating. So we saw, and we're not unusual, so at NabTrade, we just saw a massive uplift of new investors last year, absolutely massive, 5 times the average number of new investors opening accounts effectively in March last year. So the market collapses, and instead of retail investors heading to the exits, which is what we were taught would happen, retail investors panic when the market falls, the opposite happened. People saw it as just a golden opportunity to buy shares for the first time at a discount. This whole buying the dip, being contrarian, not panicking when things go south mentality has obviously been drummed into people. It's been really effective. So it was amazing. We saw all of these people come to market. What is most interesting to us, and I know that others have had different experiences, but at NabTrade, we're a reasonably large broker. We have hundreds of thousands of clients. What we saw was really conservative buying behavior, which tells us a bit about where people get their research and insights from. The top 10 most bought stocks, as well as most traded, but bought because there was a really strong buy bias last year. So it was about an 80% buy. Only 20% of our trades were sells. That's really unusual. And people were buying ASX 200 ETFs. They were buying banks. They were buying travel stocks, which was unusual and clearly pandemic related, very clearly. And they were buying buy now, pay later. So buy now, pay later was their big bet on high growth, lots of upside potential, and travel was clearly it's beaten up, it's going to come back eventually, and banks were sort of a conservative option where they knew that they would be standing at the end of this and probably going to do really well. It was quite concentrated what they were buying. We didn't see small stocks. We just saw this real enthusiasm to buy the kinds of names they would have bought in the past but liked to buy cheaply. And it tells you that their research had been done both before and during, and that they're picking up sort of that broader story that you buy things when they're at a discount, but they need to be high quality and they need to be around when the pandemic is over.
Given we're in a bull market, there's currently a lot of excitement in the market. What factors threaten to derail these gains?
They say markets climb a wall of worry, and the wall of worry is just getting steeper and steeper and steeper. And the concerns that are talked about at a global level, and it is global, Australia is a small economy and it's a small open economy, so we are absolutely affected by what goes on in the rest of the world, and some of our best companies are. The biggest issues I think I look at, and most economists are looking at, we've had record low interest rates and now zero interest rates for better part of a decade, right? Falling rates, very low rates. That will change at some point. Rates will start rising because we're seeing inflation rise. Rates will rise to try to dampen that massive increase in inflation. That will put a stop to a lot of behavior that has been taken as normal because it's been going on for so long. So all of that will absolutely affect markets. You are never going to pay 100 times earnings for a stock when interest rates are 5%. And many people trading have never seen interest rates at 5%, but I certainly have. And older people have, we know what that feels like. But young people, they've never seen it. We have an issue, though, where we've got an incredibly indebted consumer, and the average Australian population, average Australian homeowner anyway, is incredibly indebted. So there's a lot of levers that need to be pulled very, very carefully. But the economy's come back extremely strongly from the pandemic, and that makes record low rates hard to maintain, right? We need to do something about it. So it's going to be very interesting to see how it plays out.
Now, to keep investors safe online, do you think regulating social media should be the responsibility of regulators, technology companies, or the users?
Pretty clear under the law. So the Corps Act makes it very clear that it is the regulator's responsibility. Corps Act doesn't really contemplate technology companies because they weren't a thing when it was written, but it is very clear the regulators have responsibility for this. That doesn't mean that they're all seeing and all knowing. And so there is certainly responsibility right across the market and across the industry, and even more broadly for people and companies that are observing behavior that's clearly outside the regulatory framework. If you're giving people financial advice, even if you don't think you are, you need to fall within the regulatory framework, you need to be licensed, you need to have qualifications, all that kind of stuff. It's kind of got a bit out of hand, I think, in some small sectors of the market. So there's certainly an opportunity for social media companies and for members of the public and for the ASX and for many others to go, hey, we're seeing some stuff we're not comfortable with. And that gives the regulator much more opportunity to act. So it's not just the regulator. We all have a role to play, but they're the ones who are ultimately responsible for managing it. I think for the rest of us, it's hard to watch, assuming nothing's going to happen, so we can all play a part.